Yeah. So value-added tax. So value-added tax is an increase in the value of goods and services in the process of production and delivery. So it is that value added, that word value added, before we even look at the tax. So when you are adding value to any item you are buying, so it is expected the government will collect what is called a value added tax, which is another form of tax. So because they believe that value has been added by you selling the product. And this type of tax is an indirect tax. It's a form of indirect tax that is collected by the government towards general authority. So one thing about this tax is that it is the final burden of the tax is borne by the final consumer. So the consumer will bear the final burden of the tax, which is the person that is going to bear the final burden of the tax. So it's borne by the consumer. The person it is a multi-stage level collected at each point of sales from production to consumption, and the burden is borne. So as I said earlier, the burden is borne by what? By the final consumer. It is a form of tax that replaces what is called the sales tax. Before the value-added tax was introduced by the government, so in 1992, which came in effect in 1993, they usually have what is called sales tax, which is what they charge which is charged by the government. So because the sales tax is usually charged as what? At only one stage. So the sales tax is usually charged at one stage. So they decided to introduce what is called value-added tax. So this value-added tax is a tax that replaces the sales. It was charged at the rate of 5%. It was initially charged at the rate of 5%. So which is now 5%. But from the Finance Act 2019, which came in effect from February 1, 2020, 5%, which is still which is the prevailing rate that is applicable, that is adopted by the government as at this moment. So the rate for the value-added tax is still 7.5%. And this tax is collected by the Federal Inland Revenue Service. It is only collected by FRS, unlike the other type of tax, like the withholding tax, which is collected by both the FRS and the state, only by the Federal Inland Revenue Service, which is now after collecting, they now share that is a ratio, which is usually distributed to the various arms of government. So it is governed by by the Value Added Tax Act, VAT Act, which is called the Value Added Tax Act. So which is the legal basis governing the activity of the value added tax. So as I said, it replaced the sales tax, which is charged at the various stages of distribution to from the production to distribution. So and basically, the value added tax is usually borne, as I said, by the final consumer. And as liable to both value-added tax and withholding tax. But what will happen is that the payer, the person who is going to suffer the burden may differ. Implemented.
So your network is breaking.
So before now, there is usually dispute between those transactions that will be regarded as goods and those transactions that will be regarded as services. So as a result of that, the Finance Act has specifically define what is regarded as goods and what is regarded as services. So for goods is now goods is now regarded as all form of tangible property that are movable or immovable, but does not include land and building, money, or security. What can be regarded as goods are those anything that is either tangible or intangible, anything that can be seen or cannot be seen, which can either be moved or cannot be moved. And this does not include land and building, money, or security. What this means is that when there is when you are paying your rent, rent is not is no more liable to value-added tax. Because because it has been excluded by by the act as not as not part of as item that does not include goods as defined by by the Tax Act. Also, money or security, when there is when there is disposal of money, whether the foreign currency or security, when you are selling your shares, those also does not give rise to to the payment of value-added tax. So any form of goods that is either tangible or intangible will be regarded as any type of property that is either tangible or intangible are regarded as goods. So why services are anything other than goods or services provided under a contract of employment? Anything other than goods. That is, services will be anything that you cannot classify as a goods, will be regarded as a services, but services also does not include services provided under a contract of employment or services provided under a contract of employment. That is, when you are when you are being employed by your employer. So when your employer is paying you your salary. So what that means is that so for your employer to pay you your salary, that means you are providing him, you are rendering certain services to him for him to pay you that salary. So any salary paid to you by your employer is not is also not regarded as as a services that is liable to value-added tax. So what that means is that wages and salary also does not constitute services that is liable to value-added tax. Then we also services are also any intangible or incorporeal property like patent, copyright, goodwill. Those are what? Intangible or incorporeal, over which a person has ownership or right, from which he derives benefit and which can be transferred from one person to another. Any services are also what? Intangible. All these are intangible, or all these were incorporeal property like patent, goodwill, patent, copyright, and so on and so forth, over which somebody is having a right over that, excluding interest in land, building, money, or security. So when you are also generating income, when you also have like royalty, when you are receiving a royalty from where? From your building, or from your money, or from your security that you have. Those also does not what? Can also not be regarded as what? As services. So basically, goods are what? Are any tangible property which are what? Movable or immovable, which exclude what? Land and building, money or security. While services are anything that cannot be regarded as goods, or any services that you are providing under what? Under a contract of employment, or any incorporeal or intangible property are regarded as what? As services. So there are also ways of what? Of determining how to what? How to look at all these what? All these goods or services. So which I'm going to explain further. So I want to omit this way. So I'm still going to come back to it when I explain. I want to explain certain aspects first before I come back to this. Then what are the objectives of VAT? So the reason why government introduce VAT is what? To increase what? Government revenue. They need what? They need that revenue to what? To be able to what? To provide what? The various amenities that what they are providing. As a result of that, they decided to what? To introduce VAT. To make the tax system more transparent. Then to make what? To be able to make the tax system more transparent, because what? It is usually what? A type of what? Self-accounting in nature, as it is what? It is done. Then we also have to reduce tax evasion practices, because it is usually, so as you are engaging in the transaction, it is expected that what? The VAT must be added as part of what? As part of the cost of the transaction. So it's avoid the process of what? Evading tax by what? By taxpayer. Then to increase export, because when it is not all items that are what? That are liable to VAT. As a result of that, so this will encourage export, because any item that are usually that are being exported are usually charged at what? At zero rated. So this will encourage what? Export. To simplify tax collection procedure. As I said earlier, that what? It involves a process of what? Self-assessment. So as a result of that, the process of what? Paying tax is usually what? Simplified. Then also to check income tax evasion by concealment of actual income by taxpayer. It is also a process of what? Checking what? Tax evasion process. Then to reduce what? Cost of what? Tax administration by focusing its compliance monitoring efforts on large businesses only. Because it is this value-added tax is a system whereby what? The taxpayer will collect the tax himself and what? And pay and make the payment. So it makes what? The process of collecting the tax to be what? To reduce, and the cost of collecting the tax to be reduced as far as what? As far as the government is concerned. Then we also have features of a value-added tax. So value-added tax is a consumption tax. It is when you consume. It's only when you consume those goods and services that are liable to VAT that what? You'll be asked to what? To pay VAT. So if you don't consume those goods and services, nobody will tell you to what? To come and pay value-added tax. It is what? A multi-stage tax system. So it is payable at what? It is charged at every stage of what? Of production to distribution. As the item is moving from where? From the manufacturer to the wholesaler, value-added tax will be added, and so on and so forth. So it was initially charged at the rate of 5%, as I said earlier, which is now was charged at what? At 7.5 from February 2020. It has a what? Inbuilt self-assessment credit mechanism. So it is a system whereby what? You have to what? Charge the VAT yourself. You don't have to wait for the government to say, oh, before adding the VAT. So you have to add it once what? Once that item is what? It is an item that is what? That is liable to what? To value-added tax. Then, as far as this value-added tax is concerned, there are certain principles guiding the operation of value-added tax. Basically, there are two principles of VAT. So, we have the origin principle and the destination principle. This principle, one of them is the principle that we adopt here in Nigeria. So one of these principles is adopted here in Nigeria. We have the origin principle and the destination principle. What do we mean? What does it mean? Is that value-added tax will be charged on the item where the goods is being produced from. Value-added tax will be charged on the goods or services wherever the goods is being produced from, irrespective of whether that goods or services is going to be consumed in that location or not. So when they say origin principle, that means any country that adopts origin principle, once that item is being produced in their country, they are going to charge value-added tax on that item, irrespective of whether they are going to consume that item in their country or it's going to be exported out of their country. So most of these developed countries, especially like China, China is a what? It's a producing country. So China, they adopt what? Origin principle. Any item that is moving from China, they usually what? Value-added tax is usually added on that item, irrespective of what, whether you are going to consume that item in their country or not. So because they are already developed, and they are what? They are producing country. So whether you they charge your value-added tax, they adopt the origin principle, because you cannot do without those goods or services. They are developed country. So most of these developed country adopt this principle of what? Origin principle, in which the item will be, any goods or services will be liable to value-added tax, irrespective of whether that item is consumed in that location. Once that item is produced in their country, it will be liable to value-added tax. Then why we also have the second one, which is what? Destination principle. So destination principle means that what? Value-added tax will only be charged on goods and services where that goods is being consumed in that location. Value-added tax will be what? Will be charged on what? On goods and services where if that item is being consumed, and not whether where it is produced. So Nigeria adopt this principle. So some of the items that are produced in Nigeria, not all of them are chargeable to value-added tax, because we adopt a destination principle. Any item that is produced in Nigeria that is meant for export will not be liable to value-added tax, because we adopt a destination principle. Only the goods or services that is consumed here in Nigeria will be liable to value-added tax. So that is what. So this is what we adopt here in Nigeria, because in Nigeria we are not a producing country. So we are what? A developing country. We rely mostly on what? On importation. So as a result of that, so even though if we are saying we want to add value-added tax to our item that we want to export, so most of these developed countries where we want to take those items to, they are not going to buy those items, which is going to affect our foreign exchange. So as a result of that, so most countries that are developing, they adopt the destination principle, because they are yet to become a producing country. As a result of that, so when they produce, it is only item that is consumed in their country that will be liable to value-added tax. Any question? So as far as this value-added tax is concerned, we have some basic terminology that we need to know. So which are very important, which we are still going to be talking about as we proceed further. So one of them is vatable activity. So when you have vatable activity, so those are what? Those are goods and services that are liable to VAT. Goods and services that is liable to what? To payment of VAT are regarded as a vatable activity. So transactions that are what? That are liable to value-added tax are called what? Vatable activity. And this transaction can be what? Transaction of what? Companies. It can be what? Transaction of what? Clubs. It can be transaction of what? Government authority. It can be transaction of what? Association. Irrespective of what? Of the originator of those transactions. Once those transactions are liable to VAT, if they are part of a transaction that are chargeable to VAT, they call them a vatable activity. So it is irrespective. So it is also important to know that this vatable activity may also not be carried out for the purpose of what? Profit making. It is not necessarily that you are providing that services because you want to make profit. Once that transaction is a transaction that is liable to value added tax, it will be what? They are regarded as a vatable activity. So then should involve what? It should involve a supply of goods and services to another person. So any transaction that is liable to value-added tax are regarded as a vatable activity. Then we have the second one, which is what? Taxable or vatable period. Taxable or vatable period. So taxable or vatable person, taxable or vatable person. So this taxable or vatable person are those company, government agency, association, club who trade in vatable goods and services for a consideration. All those businesses, all those organizations that engage in what? In buying and selling of what? Vatable activity are regarded as what? Taxable or vatable person. So they are agents for the collection of what? For the collection of value-added tax. Any company or any organization who trade in vatable activity are called what? Vatable person or taxable person. So once you are an agent that trade in what? In vatable activity, so you are regarded as a vatable person, in which what? You are obligated, you are expected by law to what? To charge the value-added tax and remit to what? To the relevant tax authority, which I said earlier, which the relevant tax authority is what? FIRS, within what? Within certain time limit, which is what? Which is remitted to FIRS within what? 21 days of what? Of the following month. So it is expected that when you trade in value-added tax, in vatable activity from January 1 to 31st of January, all those activity that you engage in, that you sell, that is liable to value-added tax, you must what? You must charge value-added tax on them and what? And remit it to what? To FRS within on or before what? 21 days of what? Of the following month, which is what? On or before 21 days of what? Of February, when in the case of what? In the case of transaction related to from where? 1st of January to what? 31st of January. So those people that sell what? Goods and services that are liable to VAT, in simple terms, are regarded as what? Taxable or vatable person. Then we have vatable period. So vatable period, this is a period of what? Of 1 month. It's a period of 1 calendar month, commencing from where? From the beginning of the month to the end of the month. So vatable period is usually for a month. So it is expected that you must account for what? All the VAT that you collect forward on a monthly basis and remit it to what? To the relevant tax authority, to FIRS, on or before what? On or before 21st day of what? Of the following month. So for the purpose of VAT, VAT is what? Payable on what? On a monthly basis from the beginning of the month to what? To the end of the month. Then we also have what is called input VAT. So input VAT, those are the VAT that you suffered on what? on the item that you purchase for your sale, on the item that you purchase from your vendor. Those items that you are a valuable person. Those items that you want to sell, those items is not going to what? It's not going to fall from heaven. It's either you are going to buy raw material that you are going to use to what? To produce those items, or you buy those items from where? From the manufacturer. So by the time you are buying those items from the manufacturer, as I told you that what this value added tax is charged at the various stage of what? Of distribution. So that means that person you are buying from is also going to charge you value added tax. So the value added tax that you suffered on any item you purchase from your vendor is what is called what? Input VAT. So value added tax suffered on purchases is what? Input VAT. Then we also have output VAT. So that is the value added tax you collect from your sales. So by the time you now want to sell those items that you purchase, that you are selling, so you are also expected to charge value added tax when you are selling. So the value added tax that you charge on those items you are selling is what is called output VAT. So basically, VAT on sales is what? Output VAT, while VAT on purchases is what? Input VAT. So you may have a scenario whereby, and the law gave you an opportunity to what? To remove this your input VAT from your output VAT. Unlike in the case of what? Withholding tax, whereby you cannot remove your withholding tax payable from your withholding tax claimable. But in the case of value added tax, the law gave you a right to what? To remove your input VAT from your output VAT. In which case, your input, the difference between input VAT and output VAT will be what? So the difference between input VAT and output VAT will be what? Will be what you are either going to pay or what you are going to claim from the relevant tax authority. As I said earlier, that input VAT is the VAT you suffered on your purchases, while output VAT is the VAT you collected from your sales. If your input VAT is more than your output VAT, where your input VAT, that is the VAT you collected, is more than the VAT you suffered in any month. So the difference is what is called VAT payable, which is called a VAT return. So that is the excess of your output VAT over your input VAT. So that is the amount of VAT you are expected to remit to the relevant tax authority when your output VAT is more than your input VAT in what? During a VATable period. You can also have a scenario whereby your input VAT will be more than your output VAT. In any period, if your input VAT is more than your output VAT, so that means you have a refund, you have a claim to claim from the relevant tax authority. So that means you have suffered more than what you collect. In that case, it is expected that you should get what is called, that will give rise to a VAT refund. That is if your input VAT is more than your output VAT, excess of input VAT over the output VAT. So it's called what? VAT refund, in which what? The refund will now be given to what? To the taxpayer in the form of what? Either by what? In the form of credit or in other form. Either you claim it as a tax credit for what? For your future VAT payable, or in other form. So those are the two types of. So basically, the two types of VAT that we have is what? That can be collected by what? By a VATable person is called what? Input VAT and what? Output VAT. And you have a right to what? To set off them against one another. So as the tax law give you that opportunity. Then we have a taxable supply. So taxable supply. So any VATable item that you sell for a consideration is called what? Taxable supply. I told you here that we have a VATable activities. Those are activities that are liable to value added tax. So those activities now, when you are now selling them for a consideration, so it is now called what? Taxable supply, which will now be what? Liable to what? To value added tax. You are selling them for an amount. So that amount make them to become what? A taxable and a transaction that is liable to what? To value added tax. Then we have what? VAT exclusive. So when they say an item is VAT exclusive, what that means is that exclusive, look at that word exclusive. That means it's not included. So when they now say an item is VAT exclusive, when you are giving in the question that VAT exclusive, what it means is that what? The VAT amount is not included in the information given to you. The VAT value, the amount of the VAT is not included in the figure given to you by the examiner. Take note of that. So when they say VAT exclusive, that means the value of the VAT, value added tax, is not included in the invoice price. So if the value of the value added tax is not included in the invoice price, so that means the invoice amount is stated at what? 100%. So what that means is that what? So in order for you to calculate your value added tax will now be calculated at the rate of what? At the percentage of what? Of the invoice price, which is what? 7.5% of the invoice price, which is what? 7.5 divided by 100 multiplied by what? The invoice price. Because what? The value added tax is yet to be included in the invoice price. Then you can also have what? VAT inclusive. Inclusive means that what? It is included. So when they say VAT inclusive, that means the amount of the value added tax is included in what? In the figure given to you. VAT inclusive. The amount of the value added tax is included in the figure provided by the examiner. So when an item is VAT inclusive, so for you to get the so that means that item is what? Is at the rate of what? 100% plus 7.5. So when you add 100% plus 7, that will give us what? 107.5. So to now get the amount of the value added now, to now get the amount of the value added tax, so that will be what? 7.5 divided by what? 107.5 multiplied by what? The invoice price given to you. So the examiner will usually tell you whether the item is what? VAT inclusive or VAT exclusive. But you may have a scenario whereby the examiner will be silent. In a situation whereby the examiner is silent, whereby the examiner did not say VAT inclusive or VAT exclusive, please, you have to assume what? VAT exclusive. So take note of that. Where the examiner is silent, we assume what? VAT exclusive. Then we have what? The tax point. So the tax point of this determining what? When to charge the value added tax, which is what? Under the tax point, we have what? The basic tax point and what? And the actual tax point. So which is what? The tax point is just what? The determination of the period in respect of which your VAT is payable or reclaimable. That is, in what period are you going to start what? Paying what? The VAT, or in what period are you going to start what? Is the VAT become what? Become reclaimable or become payable. For goods, the basic tax point for goods also is the day the goods are what? Are removed. So if you have sell an item now, so whenever that item is being removed from your warehouse, it is expected that what? Value added tax become what? Become due on that what? On that item. So while for services, the basic tax point is what? So is the point when the date the services are performed. So whenever you have performed the services, it is expected that what? The value added tax become due as far as what? As far as what? The value added tax is concerned. Then we now have what? The actual tax point. When are you supposed to now what? Recognize what? Recognize the value added tax. So the actual tax point, you are supposed to recognize the value added tax on the invoice date. So the value added tax is expected to be recognized on the invoice. So usually the invoice date, where that invoice is raised or payment is made before the basic tax points. Yeah. You know, we say basic tax point is what? When the goods are being removed. You may have a scenario whereby what? You are yet to what? To carry your goods, but you have already what? You have already made payments. I have paid for what? For the item. I now say that I'm looking for a bus that I'm looking for logistic company that is going to help me to carry those items. So give me like one week. So I'll come and carry it. So that means I have already made payment. So that means I also you have to look at your actual tax point, because your payment has already been made before removing the goods. So in that case, it is usually the invoice date. Where that invoice is raised or payment is made before the basic tax point, there is an earlier actual tax point created at the time the invoice is issued or payment is made, whichever occurs first. That is, I have already made payment before removing the goods. It is stated that you are supposed to what? To account for the VAT when the item is being removed. So when you have sold the item and it's the item, but I have already made payment. So what the law is now saying is that because payment has been made, you are also expected to start accounting for. Also have a scenario whereby what? The item is not supplied at once. So you are supplying the item bit by bit, continuous supply of services. So where there is continuous supply, where services are supplied on a continuous basis and payment are received from time to time on a regular basis. So you are selling an item to somebody. Based on that item, you are saying, okay, I'm going to sell 100 carton to you. But this 100 carton, I'm not going to sell it at once. I'm not going to give you that 100 carton at once. I'm going to be supplying those 100 carton on a continuous basis. I'm going to be supplying you those items 10, either 2020 or by 2020 batch. So that means your item is what? There is what? Continuous supply. So that means when there is at every time there is supply of that item, invoice is going to be what? Issued, or payment is going to be made. So what the law is now saying is that so when there is continuous supply of goods or services, you are not going to recognize that item at once. You are going to be recognizing that item for value-added tax whenever there is what? Whenever invoice is being issued, or whenever what? Payment is being made at every interval. So at what? At every interval, value-added tax will be what? Will be recognized. So basically, so for the tax point is usually what? The earlier of the date an invoice is issued, the date payment is received, or the date title of goods is passed or service are concluded. The earlier of any of these 3 days will become what? The tax point in which what? The value-added tax will be recognized. So to determine the tax point, some situations are being introduced. We have where no invoice needed, where you don't need to issue invoice to what? To the customer. So the value-added tax will be recognized at the date of supply. Till you are supplying that item, you have to what? Account for what? The value-added tax, because you are not going to issue any invoice. Then VAT invoice issue. When there is what? When VAT invoice is issued, then is the date of what? The date of the invoice. Payment or invoice issue in advance of supply. Date of payment or invoice, whichever is earlier. The payment in advance of supply and no VAT invoice yet issued. Then you have already made payment in advance, as I said earlier, but they are yet to give you an invoice. The VAT will become due as at the date of what? Of making the payment. So which are the date of the value-added tax. So to recognize the tax on the value-added tax. So as a result of that, the tax points, I'm now going to go back to this definition of goods and services, which I said I'm going to come back to. So for goods and services, so the law is now saying the following should be noted. In respect of goods and services, so the following should be noted. Goods and services shall be deemed to be supplied in Nigeria. So in respect of goods, you are going to say an item of goods is supplied in Nigeria in respect of goods if that item is physically present in Nigeria at the time of supply. For you to say an item is supplied in Nigeria, for goods, that item must be physically present. That item must be available here in Nigeria. For you to say what? That item is supplied here in Nigeria. For you to be liable to what? Value-added tax. If it's an item that is what? That is imported from outside Nigeria, that item must have landed into Nigeria, must be present here in Nigeria. for it to be what, liable to what, value-added tax. Then the beneficial owner of the right or over the goods is a taxable person in Nigeria, and the goods or right is situated, registered, or exercisable in Nigeria. So the owner of that item is also what? Is also what? Available here in Nigeria. Therefore, if services to also be liable to value-added tax in Nigeria, the service rendered in Nigeria by a person physically present in Nigeria at the time, the service rendered in Nigeria by a person physically present in Nigeria at the time of providing the services. Then, for you to say if that service must be what, liable, a service will be liable to value-added tax. So the service must be rendered in Nigeria by a person that is present here in Nigeria. So the service must be rendered. That is, both parties are what? Are here in Nigeria. So in that case, that services will be liable to what? Value-added tax. Also, services are provided to a person in Nigeria, regardless of whether the services are rendered within or outside Nigeria. Also, where a service is provided from abroad, but that person that is enjoying that service is what? Is available here in Nigeria, that service will be liable to what? To value-added tax. So what that means is that any item that is what? Any services that is provided from outside Nigeria is also liable to what? Value-added tax, provided that what? That the beneficiary of that services is what? Is physically present here in Nigeria. So this provision now indicates that what? That services performed in Nigeria to a person in Nigeria is liable to VAT, which I explained earlier, irrespective of what? The residency status of the service provider. So whether the service provider is in Nigeria or not. So once that person who is going to enjoy that service is physically present in Nigeria, that service will be liable to a value-added tax. The services provided to person who are in Nigeria, regardless of the medium of delivery of the service, is liable to VAT in Nigeria. Yes. The service rendered remotely, for those services that are rendered remotely, online services, to a person that is what? Resident or person available in Nigeria are liable to VAT. So where a third party is contracted to provide a service on behalf of a non-resident to its permanent establishment of office within such a service attract VAT. So a company that does not have an establishment in Nigeria, they don't have a permanent resident. They are not what? They are a non-resident of Nigeria, but they appoint an agent to provide a service on their behalf. So soft services will also be liable to what? To value-added tax, provided it is rendered to what? Somebody that is what? That is available in Nigeria. So basically, services rendered to and consumed by a Nigerian resident while physically outside Nigeria is not liable to VAT. So value-added tax is not based on residency. So whether you are a resident of Nigeria or not, once you are what? You are available in Nigeria, you enjoy that service or that you are consuming that goods here in Nigeria, whether you are a resident or not, you are going to be what? Pay value-added. You are going to be liable to payment of that value-added tax. So what that now means is that if you are a resident of Nigeria, so if you are now what? If services is now rendered to you outside Nigeria, that service will not be liable to what? To value-added tax. So once you are not physically present here in Nigeria. So once you are not physically present in Nigeria, if that service is rendered to you by somebody in Nigeria, but you are not in Nigeria, the fact that you are a resident in Nigeria, so that does not make that service to be liable to value-added tax. Then also, in respect of what? Incorporeal or intangible asset, the exploitation of right is made by a person in Nigeria. So that person who is the owner of the right is in Nigeria. That the right is available here in Nigeria. The right is registered in Nigeria, assigned or acquired by a person in Nigeria, regardless of whether the payment or the exploitation is made outside or within. Once the right is carried out here in Nigeria, is available in Nigeria, irrespective of where the payment is being made, it will be liable to VAT. Then the intangible relate to tangible or immovable assets located in Nigeria. So that asset must also be located in Nigeria. Then in the case of what exported services, the service will be regarded as exported under the following conditions. The service must be provided by a Nigerian resident to a non-resident. I think that people you are providing that services to is not a resident of Nigeria and does not have a permanent establishment in Nigeria. The non-resident person to whom the service is rendered must be outside Nigeria when the service is consumed. So it's also not in Nigeria as at the time of consuming the service. So as a result of that, so that will give rise to how goods and services, how VAT can be charged on goods and services. Then for you to now be regarded as what? As a vatable or taxable person. You don't just wake up and start charging VAT. You must be what? You must register for the purpose of what? For the purpose of collection of VAT. So that will now lead us to what? To registration of what? Taxable person. Registration of taxable person. Section 8 of what? Of the Value Added Tax Act mandates all taxable or vatable person to register with what? The Federal Inland Revenue Service within 6 months of the act or within 6 months of commencement of business, whichever is earlier. As at the time this value added tax was introduced, they expected that some company will have been in existence before that time. So they now expect those companies that have been in existence before they came up with this value-added tax, this act, to register within 6 months of commencement of this act. Or if this act has already been in existence now, if you are now commencing business after the act has already been established, you are also expected to register with FRS within 6 months of commencement of business. Take note of that. Within 6 months of either commencing business or within 6 months of commencement of the act, whichever comes first. And this taxable person, as I said earlier, can be government agent, can be government authority, can be government body, can be government ministry, department, it can be club, it can be organization, it can be club, it can be non-government, NGO. And once you are engaged in vatable goods and services, once you are dealing with vatable activity, you must register with FRS for the purpose of charging VAT. So every organ which trade in goods and services for a consideration is required to register with FRS VAT Directorate. The registration is to cover all business activity of the organization. A resident of Nigeria who performs services outside Nigeria should also register with local VAT office. So if you are also a resident of Nigeria, but you also deal in vatable goods and services, but those vatable goods and services are provided to those outside Nigeria, you also expected to register for VAT, because there may be reason whereby all those your vendor may also be present here in Nigeria. So also a non-resident that carry on business in Nigeria according to Section 10, so must also register for VAT. So a non-resident company that does not have a permanent establishment in Nigeria is also expected to register for VAT. So now looking at it, you don't have an office in Nigeria, you don't have an address in Nigeria. So the law is now saying you must register for VAT. So when you are now registering for VAT, you are going to use the address of of the vendor that you are dealing with in Nigeria. So a non-resident company that carry on business in Nigeria according to section shall register for VAT using the address of the person with whom it is substituting contract for. So you are going to use the address of that Nigeria resident that you are doing business with for the purpose of registration for VAT. As I said earlier, every government ministry, agency, and body of the government must also register for VAT. After registering for VAT, this VAT registration is not what? Is not by what? By organization. VAT registration depend on what? On your location. You are expected to what? To register with what? With your nearest what? FRS office that is what? That is closer to your what? To your place of business. So what that means is that where you have a company, an entity, a business, let's say a business that is having what? Various branches or various locations. Each of these branches is expected to register with the nearest what? VAT office for what? For the purpose of what? For the purpose of payment of value-added tax. Let's give an example. Let's say Nigeria Bottling Company, the manufacturer of what? Coca-Cola. So you know Nigeria Bottling Company, they have plants in Lagos, they have plants in other states of what? Of the federation. I know they have plants in Ogun State, they have in Benin, they have in some other state of the federation. It is expected that each of these plants must also register with what? With the nearest FRS office for the purpose of what? For the purpose of value-added tax payment. This is needed in order to what? To make it easier for what? For each of these locations to what? To be able to what? To be able to make payment of the VAT easily. Because assuming if their head office now is in Lagos and transaction is done at Benin, transaction is done at Ogun State, at Abuja, at various locations. So if they will need to what? To transfer all those transactions to what? To Lagos again for the purpose of what? Payment of VAT. That is also going to cause delay, and it's also going to cause bureaucracy. This is also going to cause what? Loss of revenue to the government. As a result of that, each of the location must what? Must register with what? Their nearest FRS office for the purpose of VAT. When they are registering, they are not going to register as a different company. Each company has what? Has a unique thing. They are going to use that thing. FRS office is uniform. So the thing will be what? Will be linked by what? By the FRS office. But they just need to what? To register what? With the one nearest FRS in order to what? To easy the burden for them, and also what? To make it easier for what? For the government to what? To collect what? Those taxes, those VAT from where? From each of what? Each of the vatable person or taxable person. As we have registration, we also have what is called the registration. So the tax law also expects you to also what? To also carry out what is called what? The registration for VAT. When you are ceasing operation, it is expected that when you cease operation, when you permanently cease operation, you must also give FRS notice of what? Of cessation within 90 days from the date of cessation. Failure to do that to what? To FRS is also an offense which attracts what? Penalty and what? Several penalty and interest, which we are still going to talk about. So that process of what? Of telling FRS that you have also ceased operation and you are not going to be paying, you are not going to be liable to any VAT payment is what is called what? The registration for VAT. And according to the tax law, you have what? Within 90 days from the date of what? From the date of cessation to what? To notify what? The Federal Inland Revenue of your what? Of your notice of what? Of cessation. Failure to notify what? The FRS is also an offense that is what? That attracts what? Various penalty. Then also, as a vatable person or taxable person, you are expected to keep adequate record of account of every transaction that you carry out that attracts VAT. So ignorance of the law is not an excuse. Once you charge VAT on any transaction, you must keep record of what? Of those what? Transactions. Because government are still going to ask you for those records. So, according to Section 11 of what? Of the Value Added Tax Act, you are expected to what? You are mandated, and it is compulsory for every taxable person to keep adequate record of all the transactions that what? That they carry, that they engage in, that attract VAT. Failure to keep record of this transaction is what? Is a punishable offense. That is what? that attracts what? Several penalty according to what? According to the tax law. Then, as you are keeping the record, you are also expected to, every time you engage in what? In taxable goods and services, you must what? You must raise a what? A tax invoice, which is that tax invoice is what? Is what is going to show the amount of VAT that you are going to pay to the relevant tax authority, or the amount of VAT that is you are going to what? That you are going to collect from the relevant tax authority in form of what? In form of refund. This tax invoice, we have details about what? About the transaction relating to the VAT. Some of the content of this tax invoice are the TIN number, the tax identification number of what? Of those, so of the company, of the taxable person. That taxable person that deducted the VAT, the TIN number of them will be the supplier name and address, customer name and address, the invoice number, type of supply, the type of supply that attracts the VAT, the description of the goods and services supply, rate of VAT, the rate you apply, the rate of any cash discount offered, whether there is any discount offered on that transaction, total VAT payable, the date of the supply, gross amount of transaction, tax charge, and rate applied. All these will be stated in the what? In the invoice, in the tax invoice. So apart from keeping record of your transaction and having a tax invoice, the tax law in the Finance Act 2020 introduced what is called what? The VAT threshold. The threshold, this threshold simply means that it is not all taxpayer who trade, all taxable person who trade in what? Vatable goods and services that will be liable to what? Payment of VAT. Not all taxpayers who trade in taxable goods and services will be liable to what? Are expected to charge VAT on what? On those what? Taxable activity. So those that are not liable to what? To charge VAT are under what? Are under the tax threshold. So by provision of the tax law, any taxable person or vatable person with an annual taxable supply of what? 25 million naira and below. Taxable person with taxable supply of 25 million naira and below cannot charge and collect what? VAT on what? On their taxable supply. So that means what that means is that what? Small company. So those companies with what? Those businesses with turnover of what? 25 million naira and below are regarded as what? Small company or small businesses. So those businesses cannot charge VAT or collect or remit VAT to FRS when they what? When they engage in what? In taxable supply. Even though if those items they are selling are items that what? That are liable to value-added tax. Because their turnover, their total taxable supply is not going to be more than 25 million naira. They are not going to what? They are not going to charge or remit what? Value-added tax to FIRS. So when this law now came up, there is a way to determine the taxpayer that is going to fall into this taxable supply, into this under this threshold. Why? Because if we are now in February, I don't know what is going to happen. This 25 million we are looking at is what? Per annum, throughout what? From January to December, or throughout what? The accounting period of what? Of a taxpayer. You don't know what is going to happen. We are now in March now. I don't know what is going to happen by February, whether I'm going to receive an order that is going to make me to be more than what? 25 million naira. So I cannot say, okay, now I'm not going to be charging VAT. But how do we determine what? People that is going to fall under what? Under this what? 25 million naira threshold. So determination of what? Of So how do you determine those that is going to fall under what? Under the threshold of what? of this what? Of this what? Of this 25 million naira. Just give me some minutes. So the determination of 25 million turnover threshold. A taxable person who has made taxable supply of 25 million prior to the introduction of the VAT rate shall continue. Yeah. To know whether you are going to be under the threshold, if as at the time this law came in, which is from the Finance Act 2020, if your taxable supply has already exceeded 25 million in 2019, as at 2019, last year, before this 2020 Finance Act, in 2019, by the time you prepare you look at all your taxable supply from January to December, you have already exceeded. It became effect in February. As at that February, the fact that you are yet to get up to 25 million does not make you not to fall under the threshold. That means what the law is saying is that because you have already gotten more than 25 million threshold before the law came in, you are expected to continue to be charging VAT, because basically you are going to be more than your taxable supply will be more than 25 million by the end of the year. Also, taxable person who did not attain 25 million taxable supply before 1st of February 2020 shall immediately commence, charge, collect, and remit tax and file monthly return upon attaining the threshold of taxable supply anytime within the year. That's February 2020. If, as of last year,
ọ̀dẹ̀ tí ẹ̀ conclude kan àná tí mo pè wọ́n tán tó sọ̀rọ̀ náà tó sọ pé àwọn fẹ́ gbé wọn ní ṣẹ́ẹ̀tì kan wọ́n dárúkọ ẹ̀ kéèyàn làwọn tún fẹ́ rà nítorí agbára àwọn bá kà báwọn òfin mọ̀ pé wọ́n á gbé sẹ́ẹ̀tì lágbára àwọn bá kà wọ́n á jẹ́ kí n mọ̀ ọ̀dẹ̀ sẹ́ẹ̀tì lọ́la.
So if as at
sọ pé mo fẹ́ rà kan fún wọn 8,000.
if as at February 2020, the taxpayer is yet to get to a threshold of 25 million. Let's say in 2019, your total taxable supply from January to December is just 28 million. It's just, 18 million or 20 million. And as at February 2020 also, between January to February, you are also yet to get to that 25 million. You are not expected to charge VAT because you are not yet up to the threshold. You'll only be liable to charge VAT once you get, anytime you get to the threshold within the year. If you now start counting January, February, March, April, May, June, July, August. If it was the end of the year, let's say it was as at December 2020 that you get to 25 million, that is when you start charging VAT and start remitting for VAT. If throughout that year you did not get to 25 million threshold, you are not going to charge any value-added tax. Then a taxable person who may voluntarily register, charge, collect, or remit VAT and file monthly return to FI anytime, even without attaining 25 million threshold. You can also decide to what? So you can also decide to what? To charge. So you can also decide to what? To voluntarily decide to what? To start charging VAT. If you know that you are going to, there is no way for you not to what? Not to get to that 25 million. Maybe somebody has already promised you that, don't worry. We have what? We are going to give you a contract as at what? As at April. So you know already, and you know that the value of that contract is even more than what? More than 25 million. By that, you can what? You can decide to what? To voluntarily register for the purpose of what? Charging VAT, even without what? Without getting up to what? Up to that 25 million threshold. So a taxable supplier, taxable who has not attained 25 million threshold, but expect to attain the threshold at a future day within the calendar, shall immediately comment to charge. So you also, as I explained earlier, so a taxable person who makes taxable amounting to 25 million and above within a calendar is required to file monthly VAT return. I said it. So once you get up to that 25 million, charge and what? And collect the VAT. Then a calendar year is what? Is a period of 12 months, starting from where? From the beginning of the year to what? To end of the year, depending on what? On the accounting date adopted by the taxpayer. So we determine what? We determine what a calendar year is. So basically, the VAT threshold is what? Is a period of what? Of 12 calendar months. So the VAT threshold is what? Is simply what? So those that what? That does not get up to what? Up to 25 million naira. So they are not expected to what? To charge VAT. 25 million naira in a year. They are not expected to what? To charge VAT on their transaction, and they are also not expected to what? To remit VAT to the relevant tax authority, unless if you suspect that what? You are going to what? You are going to get up to what? Up to that 25 million. You can what? Decide to what? To voluntarily what? Continue to charge VAT. Then, so we have what? An example to illustrate that ABC, Mr. ABC, a wholesaler supplier of consumer goods, commenced business in January 2019. By the end of January, the taxable supply amounted to 10 million naira. Furthermore, the taxable supply increased to 18 million in February and 26 million in March 2019. When will Mr. ABC be expected to register, collect tax, and file monthly VAT return? So if you look at this scenario, you can see that as at January, is total supply is 10 million. It's not yet up to what? Up to the threshold of 25 million. As at that January, it's not going to what? It's not going to charge and collect any VAT. Then as at furthermore, it increased to 18 million in February. In February, it's also not yet up to what? Up to the threshold. It's not going to charge VAT. So as at March, its taxable supply now increased to 26 million. That means it will what? You start collecting and paying for VAT. You start collecting VAT from where? From March. And we start remitting to the relevant tax authority in the next month, which is from where? From April. So we start charging VAT from March and start remitting to what? To the relevant tax authority from April. So the treatment is that Mr. ABC should approach FRA immediately to attain threshold of 25, which is in March, commence to charge, collect, and remit tax and file monthly return to FRA by April 2019. We'll start what? Payment to FRA from when it starts, when it crosses the threshold, which is from where? From March 2019. Then we also have SYZ Enterprise, a supplier of motor parts, commenced in January 2019, and by the end of January, the admitted supply was 20 million naira, 12 million naira. Furthermore, in February, it got an order to supply another customer's spare tax and file monthly return. His total supply is 12 million. But at February, he has gotten another supply for 18 million. If you add this 18 million to 12 million, that will give us how much? 18 million plus 12 million. That will give us how much? 18 million to 12 million.
30.
30 million. So that means as of that February, he has already what? He has already reached the threshold. So furthermore, in February, he got an order to supply another customer with 18 million. So that means if you add the two supply, 12 plus 18 million, that is what? 30 million, which by February, he has already exceeded the threshold of what? 25 million. So by that, it's expected to what? To start charging VAT as soon as what? He find out that what? He exceed that threshold, which is what? From February. And we start what? Remitting VAT in what? In May. So it will charge VAT on what? On this 18 million in February and remit it what? In March to the relevant tax authority, on or before 21st of March to the relevant tax. This threshold. We also have what is called self-accounting provision. So this self-accounting position is being introduced in relation to what? To the threshold we explained about, and also to cater from where? From certain non-resident companies, certain companies that are non-resident. Self-accounting, as the name implies, self-account. You are going to what? Account for what? For the VAT yourself. You'll be the one to account for the VAT yourself. You are going to account for the VAT yourself. Account for the VAT yourself. Section 14, subsection 3, and section 4 of VAT introduce a self-account position in the following instances. If the supplier is a person exempted from charging VAT or otherwise failed to charge VAT, or the supplier is a foreign company without a fixed base. This self-accounting provision relate to two categories of taxpayer. The first one, taxpayer that is under the threshold. Because I'm under the threshold, that does not mean that I'm not going to sell to what? Because I'm a small company, that does not mean that I'm going to sell only to what? To small company. The fact that I'm a small company, I can sell to medium company and large company. And those ones by law, they are mandated to what? They are liable to what? Payment of VAT. And the tax law have stated that because I'm a small company, I cannot charge VAT. So that means if I'm selling to what? To a large company, or if I'm selling to a medium company, I'm not going to charge them VAT. What the law is not saying is that because I'm a small company, which I am under the threshold, I'm not expected to charge VAT. That company that is buying for me must self-account for the VAT themselves. That provision is called self with a that is under the threshold. That is a taxable person that is not expected to charge VAT. And you know that transaction is a transaction that attracts VAT. And that person is not going to charge you VAT because it's exempted from charging VAT because it's a small company. You that you are buying that small company, you must what? You must add VAT to your invoice and self-account for the VAT on that transaction and remit it yourself to the relevant tax authority. That provision is called self-accounting provision. This is also related to a non-resident company, a foreign company that does not have a permanent or a permanent establishment or a fixed base here in Nigeria. They don't have an office here in Nigeria. They don't have anywhere where you can trace them to in Nigeria. So anybody they are dealing with in Nigeria, before you pay them, once they give you your invoice, it is expected that that invoice they give you, you are going to add VAT on that invoice by yourself and put VAT on that invoice and remit it to and charge it because you are present in Nigeria. You are going to what? Withhold that invoice, that VAT, and what? And remit it to what? To the relevant tax authority. It's possible that the foreign company may not charge VAT on that transaction. Why? Because what? They are not registered for VAT in your country. And what? They don't have an office in your country. So once they give you their own invoice, and you see that invoice, VAT is not included, the next thing for you as a customer that is what? That is available in Nigeria, you must add VAT to that invoice. So when you are now adding VAT to that invoice, so when you are now paying the supplier, the foreign company, their money, you are not going to pay them the full money with the VAT amount. You are going to withhold the VAT amount. You only pay them what? The invoice value. Then the VAT amount that you withhold will now be remitted to FIRS. Though that provision is what is called self-accounting provision. And when you are self-accounting for any VAT, this will be done separately from your own work, from your own VAT activity. Because you, as a company, you also have your own transaction that attract VAT. You also have your activity that is what VATable. The one that you did that is self-accounting, will be done what? Will be carried out separately on a separate what? On a separate tax invoice. So note, where a taxable person received taxable for which VAT was not charged from either below the threshold or any person that receiving this shall self-charge and account for the VAT due. As I explained earlier, return for VAT self-accounted for or self-charged can be separately made in the form prescribed by the. So this will be done on a separate what? On a separate form, as different from where? From your normal what? Normal activity. So also, it is not all activity that are what? That are liable to value added. There are some transactions that are exempted. So exempted item. So this item that are exempted. So this item exempted, they are friend of ICAN. Please, there is no time ICAN will set question on. So there is no time ICAN will set question on what? On no time ICAN will set question on value added. They will not ask you either exempted item or zero rated item. So this exempted item now, services that are exempted. So for the goods exempted now, the following are the goods that are exempted from value added tax. The following goods are basic food items. Look at that word, basic food item. Not the food that you go to this thing to go and buy your basic food item. Not those ones that you went to eatery. So the one that's what you go to the market yourself to go and buy the ingredients. So those are what basic food item. Not the one that has already been cooked by eatery or by hotel. Those are not what basic again. So the one that you went to the market to go and buy, so are exempted from value added tax. Then all medical and pharmaceutical products, because government want good health for the citizen, those are also exempted. We have books and educational material. Government also wants you to be knowledgeable. Then baby product, they want you to have more children. So oil exports. In some textbooks, you see it as what? Oil export is not, it is what? Oil export. Oil, when you export our oil, because it is just now that what? We have a refinery in Nigeria. Those oil that are being exported, they are still going to bring it back. So that is why it is exempted. Because when they now bring it back, value added tax will now be added on them. So oil exports, so they are what? So they are also exempted. Then we have a newspaper and magazine, agricultural equipment and product, plants or machinery and any equipment used for export processing zone, plant and equipment purchased for utilization of gas. So all these are what are exempted items. We have what? Vegetable oil, motorcycle, bicycle and their spare parts, corporate bond and security, life insurance, locally manufacturing sanitary pad, towel, commercial aircraft engine and spare part, commercial and residential rent. Basically now, when I was defining definition of goods and services we made mention of excluding what? land and building. Basically, rent has been what excluded as an item that attracts or value added has been exempted. So before now, it usually costs a lot of what dispute between what the tax authority and the taxpayer. That are exempted, we have medical services, any service are exempted. Services rendered by microfinance bank and mortgage bank, play and performance conducted by educational as part of learning. So those are conducted by educational institution. All exported services. So all exported services. Why? Because once you export services, and that is not consumed here in Nigeria. And don't forget the principle we adopt. We adopt what? Destination principle. So all services that are exported are what are not are what exempted from VAT. Shared passenger transport services, which is made available for public use, like your BRT buses. So example is your BRT buses. So and this does not include hire or rented vehicles. So not those ones that you hire from logistic company. No, like your BRT buses that is usually provided for the benefit of what of the masses. Then we have a training and educational organized by what not for profit making or public educational institution. Training and so not for public making or educational institution is also what exempted. It's also so there is also what exempted from value added tax. Then we have what tuition paid for nursery, primary, and secondary education. The tuition that is payable for tuition for primary by primary school students, secondary school and what and nursery schools to their school, whether private school or public school, are exempted from payment of value added tax. Then and another important one is interest on loan, interest for advances, interest for overdraft, and interest for so any form of interest on loan. So it's not liable to value added tax. So the only thing you see on interest is what withholding tax. The interest on bank deposit not liable to value added tax. The airline transportation ticket issued and sold by commercial airline registered in Nigeria. Those that are registered in Nigeria, so any ticket they sell are not liable to value added tax. Government is doing this in order to encourage them. Then we have a hire, rental, or lease of tractor, plow, and other agricultural equipment. Then renewable energies. All these are what are transactions that are exempted from value added tax. So as I said now, so as I mentioned earlier, there is no time that question will come out on this particular top area that they are not going to ask you for what items that are least what maybe 3 services or goods that are exempted from value added tax or zero rated items. So we also have what is called zero rated goods and services. So zero rated goods and services. So these zero rated goods and services, those are those goods and services that are liable to VAT. They are liable to VAT. But the applicable rate is 0%. That's why they call them zero rated goods and services. They are those goods and services that are liable to value added tax. But the rate that you are going to apply to them is what? 0%. That is why they are called what? Zero rated goods and services. So one of them is your non-oil exports. Initially when I did exempted goods and services, under exempted goods, I mentioned oil export. Oil export. When oil is being exported, it is exempted. So now, it is not only oil that will be exported. You can also have other goods that will be exported. When you now export any goods that is liable to tax, that is liable to value added tax, the rate of that will now be applicable on that goods will now be what? 0%. Because what? We apply what? Destination principle. And once that goods is being exported out of Nigeria, that means it's not going to be consumed in Nigeria. So non-oil export, all other form of export, any form of export is what is not is like is what is at the rate of 0%, which means what value added tax will not be what liable on them. Then goods and services purchased by diplomats. So diplomats are those what are those foreign nationals that come to Nigeria to come and represent their country. They come to Nigeria to come and represent their country, but to foster trade between what? Between Nigeria and their country. So as a result of that, any item that they purchase, which is item that is liable to VAT, once they can establish that they are diplomats, those items will be what charged at what? At the rate of 0%. Why? Because they are not liable to tax in your country. They just come to your country to foster what trade between their country and your country. Then we have a goods purchase for use in humanitarian donor-funded project. So humanitarian donor-funded projects were undertaken by what? Non-governmental organization, religious or other organizations that are not for profit making or in the interest of the public. They call it what? Humanitarian donor-funded project. Example are during COVID-19, relief items that are what? That are being provided by what? By this international body, by IMF, World Bank, UN. So, they provided a lot of relief material to what? To Nigeria. So when they now gave you those relief material, so you don't expect them, you cannot tell them to come and work, to come and pay value added tax on item that they are giving you free of charge. So because if you tell them to go and pay value added, that means you are not serious. They will take it to another country. So those items are regarded as a humanitarian donor funded project. So they are items provided by what? By international organization or other organizations that are not for profit-making organization, for profit-making aim, but which are only meant for public interest. So they call them what? So those are those items that are zero rated. So you may also be asked for what? Items that are also zero rated. Then we have what are the difference between what? Zero rated and this one and these exempted goods and services. Difference between zero rated and exempted goods and services. I mentioned earlier that what the tax law gave you a right to remove your input VAT from your output VAT. So when an item is exempted, that means any input VAT you suffered on them, you cannot claim them back because those items are what? Exempted. Any input VAT suffered on them cannot be what? Cannot be claimed back. But if an item is zero rated, any input VAT suffered on them can be claimed back from your output VAT. Because if an item is zero rated, that does not mean that that item is not liable to VAT. But the rate you are applying is what? 0%. So that means any input VAT you've suffered to buy those items, you have a right to claim them back from your output VAT. So that is just this simple difference between exempted and zero rated item. So exempted item will not be any input VAT suffered on them will not be available for claim, will not be available for claim from the output VAT. But while in the case of zero rated, for zero rated, any input VAT suffered on them will be claimed back from the output VAT or can be refunded if there is no output VAT. Then we may be asked for problem of zero rating include the following: registration. So some of these companies that are that dealing with zero rated item, they don't usually register. They will just tell you that because maybe our item are zero rated, is 0% now. So why do we need to bother ourselves? So it's one of the then return. Because your item is zero rated does not exclude you from filing return. So most of these companies that this zero rated item, they end up not filing return to the relevant tax authority. Then verification and tax audit. So they still have they are still under the scrutinization of the tax authority to carry out a tax audit and verification on them. So refund, to claim refund for input VAT under zero rated is not that easy, because If an item is 0 rated, I have suffered input VAT on it. When I want to sell it now, you are telling me I should not charge VAT on it. So that means I'm not going to see anywhere to remove my input VAT. Government is expected to give me back that money. And to collect money back from government is not that easy. So it's usually a problem. So then cash flow problem is also going to cause a cash flow problem to what? To the taxpayer, because it's going to tie down my money. I have suffered input VAT. So, and you are telling me not to collect what? The output VAT from the person I'm selling that item to. Is what? It's going to cost one. So that means it's tying down my fund. So fraud is also going to be prone to fraud, because many companies they are going to look for ways to form transactions that are not 0 rated and try to claim them as 0 rated items. So those are items that are regarded as 0 rated. Then we also have some items that are non-vatable activity. Like as I said earlier, your wages and salary from your employment, you cannot charge your VAT. So the only tax that can be charged on your wages and salary is your payee, personal income, your personal income tax. Then we also have hobby activity that you are doing that you are not buying. So then private transaction. So transaction that is for your private purpose, the house rent, commission on turnover, interest, and so on and so. All those are transactions that are non-vatable activity. So those are the transactions that are not liable to value added tax. So as a result of that, at this level, for the purpose of your ICAN exam, as I said, you need to have a better understanding and knowledge of those transactions that are exempted and those transactions that are 0 rated. Because the examiner will not tell you that in the question it will give you that, okay, this transaction is 0 rated. It will just tell you the transaction. It's now left for you to link it to whether that transaction is exempted or that transaction is 0 rated. So those are the various transactions that are liable to VAT. Then we have we have types of VAT variants. So there are 3 types of VAT variants. We have the gross product variant, income tax variance, and the consumption variance. So those are the 3 forms of tax variance. So under the gross, that is gross. So deduction will be so the gross means that you are going to remove all your purchases, all the purchases of raw material and components. So deduction, so all the purchases of your raw material and all your components will be deducted from so all the VAT you suffered on all your purchases will be removed from your output VAT, so from the sales VAT. So, but when you are removing that, no deduction is made for capital goods such as plant, machinery, and depreciation. So under the gross product variant. Then we have the income tax variant. This allows deduction for purchases of raw material and component plus depreciation on capital asset. So this one, for your capital asset, you are also going to include the depreciation on the capital asset from the item that you are going to remove from your output VAT. While for the consumption variant, so the economy base is equivalent to the total private consumption here. Deduction are made for all business purchases and capital, all purchases and capital assets. So will be liable to value added tax. They expect that you must charge back on all your items, and any item you are purchasing must be liable to value added tax, which is what consumption variant. That is, once you are consuming an item, you are buying an item, you must pay VAT, and value added tax must be liable to the VAT. So then we have method of calculating this value added tax. There are three methods that we can use to calculate the value added tax. We have the invoice credit method, we have the subtraction method, and the addition method. So those are the three methods of calculating the value added. Invoice credit method, subtraction method, and the addition method are the three methods of computing or calculating VAT. So we have the invoice credit method, subtraction method, and addition method. Any question? Any question? So in the absence of no question, so we are going to stop the class at so we are going to continue our class from the various method of what? Method of computing what? Computing the value added tax. So as I told you, we have a three method of computing the value added tax. So which is where we are going to continue the class. So next week. So have a lovely week.